Hello and welcome to the Scan the Markets webinar with me, David Madden. I'm a market analyst at Equity Capital here in London in the UK. Equity Capital is a part of the wider equity group, which of course includes various different organizations such as FXPesa in Kenya and Equity Nigeria. Now, what I'm going to do is for this live webinar is to kind of run through a handful of the major macroeconomic markets, covering commodities, covering some currency pairs, covering some indices, talking about the major kind of topics and themes of the trading session. So starting off here with a very popular market, gold, and a market that's seen a lot of volatility recently. We can see here that gold skyrocketed to its highest level since August 2020, at the beginning of the month, when concerns and fears about the war in Ukraine were at its peak. Since then, sadly, the violence in Ukraine continues, but markets are less fearful of the war as they once were a few weeks ago. And broadly speaking, we've been moving a bit lower. We've been moving lower in relation to the price action of gold in the last couple of days, and today we've seen a bit of a bounce back. The latest development in the Russia-Ukraine situation is that Russia's President Putin has announced that any payments for natural gas, many countries around the world, particularly European countries, depend on natural gas from Russia. Any natural gas payments must be made in Russian rubles. And as of tomorrow, if those payments aren't made in rubles, as of tomorrow, those energy contracts will be halted. So we saw a sell-off. We saw a sell-off towards the end of the European trading session today, and in turn, we saw a move higher in gold. So the very kind of more short-term trend for gold has been higher. The much more longer-term trend for gold is higher. While gold continues to hold above these three simple moving averages, it's likely the short-term upward trend is going to continue. If you look at the MACD indicator, we can see that momentum is in positive territory, and a positive momentum is increasing, which suggests the bulls are gaining influence. Looking at the RSI, it's moving higher, suggesting the price bias is to the upside. If you do see continuation of this rally, this could be encountered at 1966, but a break beyond that could see a target in 1978. As I mentioned, we have seen a lot of volatility in gold recently. In recent weeks, a more medium-term trend has been lower. If you don't see gold retake the 1966 area, this peak here, that could be an early warning sign that the more medium-term bearish trend is still in effect. If you do see a move to the downside in gold, where can we move? Where can we potentially find support? Well, possibly down at 1905, and a break below that could see a target at 1890. Now, if you are trading gold, it's worth keeping an eye on the price action of the US dollar. Gold, like other major commodities, is listed in US dollars, and it's not always, but there can be an inverse relationship between gold and the US dollar. So often on days you see that the US dollar has suffered large declines, gold often rises, and on some days when you see a large rally in the US dollar, you see gold decline. Now, why it's important? Because we have the US dollar influence is important because of the rising inflation levels in the US. Headline CPI in the US is 7.9%, its highest level in 40 years. Today, the US core PCE reading came in at 5.4%, up from 5.2%. Once again, further signs of higher inflation. Looking ahead to tomorrow, which I'll cover in other charts, is the US non-farm payrolls report. That's going to give us an update on the US labor market for the month of March. And if we do see a strong US labor jobs report, that could lead to a stronger US dollar, which in turn might lead to a weaker gold market, and vice versa. If we see a weak jobs report, that could put downward pressure on the US dollar and in turn drive up the price of gold. But it all depends on which way the numbers come in. And speaking of movements in the dollar, let's take a look here at euro dollar. So obviously we've had a relatively hawkish Federal Reserve in recent weeks and months. At the most recent Federal Reserve interest rate decision, they hiked interest rates for the first time in a number of years. More recently, the Federal Reserve have been suggesting or kind of hinting at they might actually hike interest rates by 50 basis points, 0.5%. So the Federal Reserve are actually becoming a bit more hawkish in their language. What's also influencing the currency pair, of course, is the war in Ukraine. Many Eurozone economies, such as Germany, Italy, and the Netherlands, import a relatively high portion of their natural gas from Russia. As I mentioned a minute ago, the Russian president is now demanding that any gas payments for Russian any payments for Russian gas must be made in Russian rubles from tomorrow onwards. And if they're not made in Russian rubles, the contracts will be ended. What's also likely to influence the euro-dollar currency pair in the next 24 to 48 hours is the US jobs report. As I mentioned, the US economy is improving, hence why we've seen a hawkish commentary from the Federal Reserve. If you continue to see an improvement in the US labor market, it's possible we could see a continuation, an upward move of the US dollar, and in turn a downward move in euro dollar. So if you take a look at the much wider term trend in euro dollar, it's been broadly speaking been moving lower. The lows that we saw here in early March were lows last seen almost 2 years ago. But since then, we have seen a fairly large rebound in euro dollar. So the more medium term trend has been higher in euro dollar, although in the last few hours we did see renewed selling pressure. Why is this? Well, partially because of the high US inflation figures that come out, the core PCE numbers, but most of it's due with the kind of demands from Russia about gas payments being made in rubles, and that kind of ramped up rhetoric again and shook stock markets, and in turn put pressure on the euro as well. We can see here that as the currency pair has been driving lower, and the MACD indicator momentum has swung from positive territory to negative territory, suggesting that the bears are now in control. The RSI has been moving lower as well, suggesting the price bias is to the downside. If you do see a continuation of the short-term bearish move in euro dollar, support could be found around here at one spot 10.70, and a break below that could see us back down towards this simple moving average here around one spot 10.49. If you do see a break below that, the next big level I'll be watching out for in euro dollar will be down towards the lows of around the lows of the lows in around earlier on this week, which came into play in around the 28th of March, in around just south of 110, in around kind of 109.40, 109.45. They're the sort of levels I'll be looking out for to the downside on euro dollar. If we do see a continuation though of this more medium term upward trend, and if euro dollar can continue to hold above the kind of the 110 area, it's possible the more medium term upward trend will continue. A rally from here could see a retest this area here at 112 spot 12.32, and a break beyond that could see its target 1 spot 12.73. Looking now at the US 500, the S&P 500, well, the US 500, as we can clearly see here from about the middle of March onwards, has been in a strong upward trend. And I really want to stress the fact that this time period here, there's a lot of uncertainty. From mid-March onwards, there was a continued violence and war in Ukraine, so which caused major uncertainty in politics and the financial markets. And on top of that, we had an interest rate hike from the Federal Reserve, and we've had even more hawkish language from the Federal Reserve. The Federal Reserve might look to increase interest rates several more times this year. And on top of that, there's speculation that the Federal Reserve might actually look to hike interest rates by 50 basis points, 0.5% in May, rather than the kind of more traditional increment that they move by of 0.25%, 25 basis points. So it really says a lot about a market if it can rally in the face of such adversity and such uncertainty, whereby concerns about a war in Ukraine, concerns about a higher Federal Reserve, but yet the US 500 kept on driving higher. And one of the questions you should always be asking yourself is, what I do all the time is, rather than saying, oh, the market's wrong, the market should go down because of the war in Ukraine, the market should go down because of the hawkish commentary from the Federal Reserve, what I always ask myself, when I look at a chart, I always ask myself, what is the market telling me? And the strength of this rally tells me the market's going higher, because if you look at the price action, if you can rally in the face of a war and the face of hawkish commentary, that really underlines how much buying power there actually is out there. So in the last 48 hours, we've seen the US 500 in its highest level since January. A multi-month high was achieved, a level last seen, like I said, in January of this year. So we're talking about a multi-month high being achieved, which really highlights how bullish the recent upward move has been. If you could, I know we've retreated from a recent peak, but we're still holding above these two simple moving averages. By the way, I'm looking at a 4-hour chart here. All these charts are 4-hour charts, and this is the 20-period moving average, the 50-period moving average, and the 100-period moving average. So we've just dipped below the 20-period moving average, but we're still comfortably above the 50-period moving average and the 100-period moving average. And while we continue to hold above these two moving averages, I think the broader upward trend in the US 500 is likely to continue. If we do rally from here, where can we look to go? Well, we could have to retest the recent peaks of 46.37, and a break beyond that could see as target 46.69. Looking at the price action in the past 24 to 48 hours, we have seen the market move lower. Looking at the MACD indicator, we can see momentum has swung from being in positive territory to now being in negative territory, which suggests the bears are in control. The RSI is moving lower as well, indicating the price bias is the downside. So if we do see a move lower, a continuation of this short-term bearish move, where can we find support? We might find support from this area here around 45.38, and a break below that could see us back down towards 45.00. Now, it's worth noting that in the last few weeks, the last 2.5 weeks, buying the dip has been a popular strategy. As we can see here, a higher high, higher low, higher high, higher low. So it's been in a strong upward trend the last 2.5 weeks. And as I mentioned, buying the dip has been a popular strategy. But as with anything in the financial markets, just because something is a pattern has been in place for a few days or a few hours or a few weeks, there's no guarantees that pattern is likely to hold. If you are trading the S&P 500 or any of the US stock markets, please be mindful of the fact that the US jobs report, the non-farm payrolls report, is coming out tomorrow. What's also going to be influenced to a lesser extent by the US non-farm payrolls report is the UK market. The UK 100, the FTSE 100, has also been enjoying an impressive rally the last few weeks. It was only in the last 24, 48 hours have we seen the UK 100 back up to a 1-month high, which once again really kind of underlines how bullish the recent upward move has been. Granted, we have retreated a little bit and we've dropped below the 20-period moving average, but we're still comfortably above the 50-period moving average and the 100-period moving average. And while we continue to hold above these two metrics here, it's like the broader bullish trend will continue. If we do rally from here and we clear the recent peaks, we can then potentially look to target 76.32, and then beyond that up towards 76.88. Now, looking at the price action in the UK 100, it's similar to that what we saw on the S&P 500, whereby it's retreated from its peak. You can see here on the MACD indicator, momentum is ever so slightly now in negative territory, suggesting the bears are in control. The RSI has been moving lower as well, suggesting the price bias is to the downside. So if we do see any additional losses in the UK 100, we could see support come into play around here at 74.59, and a break below that could see us back down towards 73.85. So what's been influencing the FTSE 100 today, and what's likely to be a factor in the next few days? Well, of course, the war in Ukraine. I mentioned a couple of charts ago. Russia's president is now demanding gas payments in rubles. That's kind of shaken up the financial markets a bit, because essentially getting European governments to kind of trade in energy on his terms. So that's kind of rumble things a bit in the financial markets. What's also in focus for tomorrow is the US jobs report. Depending on the US jobs report, could easily potentially influence people's thoughts about what the Federal Reserve are going to do at the next meeting, in terms of will they have an interest rate hike, and if so, how large or small will the interest rate hike be? And lastly, what's fairly unique to the UK 100 is its composition. There's a disproportionately large amount of commodity stocks, oil stocks and mining stocks within the FTSE 100. Now, by and large, stock markets have been suffering whenever there's been heightened violence in Ukraine. But some markets that have actually performed well during the war has actually been oils and metals, because Russia is such a massive exporter of oils and metals. There are fears that minerals and commodities will be in squeezed supply. So the upward move on the underlying oil market, it was a few weeks ago we saw oil up at a 14-year high. We've seen in some cases multi-year highs or multi-month highs, or multi-year highs or all-time highs in some metals. So that's lifted mining companies, and because mining companies and oil companies make up a fairly large component of the FTSE 100, that's why we've had a fairly decent rally in the FTSE 100 compared to, say, the rally in the DAX, the Euro market, or the rally in the CAC. in the French market. So if you are trading the FTSE 100, keep an eye on what's going on in oils and metals, because that influences the various different stocks. And speaking of oil, we have here US oil on the chart. There's been the big news in the past 24 hours or so is that the United States is considering increasing, or essentially releasing some of its strategic oil reserves. The United States essentially has a kind of a fund or a pool of oil built up, which it likes to actually kind of hold on to in case of emergencies. And now they're considering releasing 1 million barrels a day for several months, equating to around 180 million barrels of oil, as a way of lowering the price of oil, cooling inflation, taking pressures off the cost of living, because obviously if oil is high, the price of energy is high, and therefore businesses and individuals come under additional pressure. What's also impacting oil? Well, of course, we had an update from OPEC Plus today, and not really a surprise, OPEC Plus essentially are sticking with their policy guidance that they're going to increase output by about 420,000 barrels of oil per day from May. Nothing too dissimilar to the policy that they currently have. Not that anyone's really expecting any major change to policies anyway, but that was in the headlines. And of course, the ongoing conflict and situation in Ukraine is likely to influence the oil market. So we can see here the oil has been particularly choppy. US oil at in early March, at kind of the height of the violence and the height of the uncertainty around the war, rallied to a 14-year high. We saw a sharp move to the downside here in the middle of March. We saw another rebound, and then we've moved lower yet again. But for all the kind of movements in oil, we've seen quite sharp movements in the last few weeks. It's worth noting that the lows of late March here are still comfortably above the lows of mid-March, and the lows of mid-March are still comfortably above the lows of late February. So in much kind of broader sense, the kind of the very long-term kind of uptrend in oil is still in effect now. And the more medium-term trend has been to the downside. We can see here that it's all good, even though it's rebounded a little, it's still holding below these 3 simple moving averages. And while it continues to hold below those metrics, it's likely in the kind of short-term bearish trend will continue. We can see here that the RSI has been moving lower. The MACD indicator is in negative territory, suggesting that the bears are in control and the momentum is with the sellers. If we do see a continuation of this short-term bearish move, it might look to retest the lows of the last 48 hours at 97.71, and if right below that, could see it's back down towards the lows or the kind of the lows of mid-March at 92.64. Now, this is a market which has obviously seen a lot of volatility. It's highly sensitive to the situation in Ukraine. As I mentioned, the lows that we've seen here and this week are comfortably above the lows that were posted in mid-March, which were comfortably above the lows that were set in late February. So if you do see continuation of the broader upward trend, if you do reclaim this peak here in around kind of 106, 107, that could be the sign that the more medium-term, long-term uptrend is going to continue. Moving higher from there, I'm looking towards 110.84, and then beyond that, up towards 113.21. And then, of course, if you clear that price, I'll then be looking for this peak here, in around kind of 115, 116. Now, speaking of coming on, that brings me nicely now to my last chart of the day, is the US dollar versus the Canadian dollar. Now, the Canadian dollar is very heavily influenced by the price action of oil, because Canada has a fairly large oil and gas sector in its economy. And as the price of oil is fairly strong and well above, when it's above $100 a barrel, that usually spurs buying in the Canadian dollar. Now, even though the US dollar itself has been reasonably strong, the US dollar has been in sharp decline versus the Canadian dollar recently. Why is this? Well, largely down to the fact that the oil market has been fairly robust and fairly strong. And if anything, if there's any kind of fears in the markets, it's probably more likely the fear is kind of skewed toward the side of oil going higher and retesting the 14-year high than it is oil actually having a massive sell-off. So even though we've had hawkish kind of commentary from the Fed in the last few weeks, that really hasn't done a huge amount to actually impact, to drive up the Canadian dollar. So this is what I mean about always kind of questioning what goes on in the markets. And by questioning, I mean actually asking, what is the market telling me, and looking at the facts of the situation and then looking at the moves. So this is the price action we've seen in dollar CAD since mid March. Dollar CAD's been in a sharp downward trend from mid March onwards. Keep in mind that we've had, in that time frame, we've had an interest rate hike from the Federal Reserve. We've had a suggestion that there's going to be several more interest rate hikes this year, and we've had commentary from a number of central bankers in the US, including Jerome Powell, the head of the Federal Reserve, who is even kind of open to the idea of having a 50 basis point hike if it's required. So, if dollar CAD can't, rally in a period like that, when can it rally? This is the kind of questions I'll be asking myself. So it seems to me it's in a fairly aggressive downward trend. On a few occasions that we have snapped back, the rallies really haven't been that large. We can see in the last 24 hours, we had a rally back here. The peak that we set here still got nowhere near retesting this peak or these peaks along here. And lo and behold, the market's turned lower again. It's now back below all three of these simple moving averages. If we continue to hold below these three simple moving averages, it's easy to if you continue to hold below these three simple moving averages, it's like the more broader bearish trend will continue. If we do move lower from here, we could be looking back down towards 123.86, and a break below that could see us back down towards 122.99. Now, if we do get a rally from here, if you do happen to stage a rally, where if we look at the target, well, I'll be looking first and foremost toward this peak here and at 1.2592, this high here, and then beyond that up towards 126.45. I'd really need to see, dollar CAD probably kind of move above this peak here or the 126 area before considering kind of altering my view. I think to myself, right, maybe we're now going to see a move to the upside in dollar CAD. Just bear with me now 1 second, please. I believe there's might be a question or two coming in. Of course, if anyone is live right now, wants to ask a question, feel free to fire away. I'm going to analyze dollar yen and sterling yen. Sure. Take a look now at dollar yen and sterling yen. Do we have those in the charts? One moment, please. Dollar yen and sterling yen. So dollar yen, if I recall correctly, when they hit the peak it saw this week was something like its highest level since about 2015 or 2016. It was a huge rally in dollar yen. It was, massive. 2015 by the looks of it. So it was a massive move to the upside in dollar yen. If the market's hitting its highest level since 2015, that really kind of highlights how bullish the market is. So the really long-term view for dollar yen is to the upside. Like I said, why is this? We've had hawkish commentary from the Federal Reserve. Also, what's been going on recently? Remember that chart I showed you when I talked about how the likes of the S&P 500 has been having a very strong rally. Well, if stock markets are rising, chances are risk-off assets such as gold and the Japanese yen and the Swiss franc, chances are they're falling. That's precisely what we're seeing here. So it's no coincidence that this week we saw the S&P 500 hit a 3-month high, while at the same time we've seen weakness in the Japanese yen because people are going, you know what, I'm no longer fearful as I once was. I'm taking my money out of low-risk assets such as the Japanese yen and investing it in stocks. So once again, if you're trading a currency pair like dollar yen, even if you're on this paper that says, oh, I don't trade stock markets, you need to be looking at what's going on in stock markets because whatever's going on in the Japanese yen can often be the inverse of what's going on in stock markets. So multi-year high on dollar yen tells me the market, the big picture view is to the upside. Fair enough, you've had a fairly large correction or fairly large move to the downside, but in the grand scheme of things, you know, we do appear to be kind of finding a bit of support in around here. There's a few occasions where the market tried to kind of break below the kind of down towards 120, 121 and didn't quite get there. And it really says a lot about a market when you've hit a 6-7 year high, and even when you've had a correction as markets do from, or a pullback as markets do from time to time, you don't even get anywhere near retesting the 100 period moving average. Once again, I'm looking at a 4-hour chart here, and all you really do is basically fall back to sort of this zone here around 120, 130. You don't even get as low as retesting, you know, 120, 60, this low here, or even get as low as like the psychologically important 120 level. So it seems to me the kind of the broader upward trend, the more medium-term uptrend in dollar yen is likely to continue, provided we hold above these two simple moving averages. If we do rally from here, I've been looking at it, kind of heading up towards this peak first of all, around 123.75. Beyond that, retesting at just north of 125, and then beyond that up towards 126. You know, as we can see here in the last few weeks, buying the dip has been a popular strategy. Notice how the pullbacks along the way were relatively small. To be fair, this is a fairly large pullback, but you know, you need to be kind of thinking about, you know, if we were to break below this area here in around one spot 120 spot 60, where can we go below that? Then possibly down towards 120. And then if we go below that, we could head back down toward this zone here. This acts as a bit of resistance on the way up this area. And then I'd be looking towards the kind of 119 spot 35, 119 spot 40 level. I was also, you know, about sterling yen. Do I have it already? No, I don't. I think sterling yen is way at the very bottom of the list. Yes, there it is. I knew where it was. So sterling yen in a similar situation, you know, multi-year highs were racked up, and sterling yen once again, the kind of common theme here, back up the levels last seen in 2015. Sterling yen hit its highest levels in 2015. Dollar yen hit its highest levels in 2015. The commonalities there is the Japanese yen. Weakness in the yen has been the name of the game. This actually ties in with one of the tenets of Dow theory, as in Charles Dow. One of the tenets of Dow theory is that the averages must confirm each other. And essentially what that means is markets that are quite similar in theory should be moving in the same direction at the same time. And if you're trading sterling yen and you're seeing sterling yen hit a multi-year high and have a bit of a pullback, chances are it's probably a case of dollar yen is probably having a similar price action. And if all the kind of yen crosses, be it, you know, Aussie yen or CAD yen or sterling yen or dollar yen, are all moving in a similar, having a similar price action at the same time, you can then be more confident of those broader trends and themes continuing. Similar fashion, I think while we continue to hold above these two simple moving averages, the broader uptrend I think should continue. Rallying from here, I'll be looking up towards this area here around 161.57, and then beyond that towards the recent multi-year high 1.6465. Beyond that 165, 166. Interestingly enough, we do appear to be finding a bit of a floor here. You know, the lows of the last few hours haven't taken off the low that was set here. And notice how the low that we saw here was pretty much bang in line with the low that was set at this trough here. So it seems to me the kind of we could be in the early stages of forming a base, even if we're not. But we could find support potentially from the 100 period moving average in at 158.30. If you follow it around, you can see how the 100 period moving average acted nicely as a support zone here, resistance point here, both support and resistance around this area. What I often say is if a metric has been of importance in the past, it makes it more likely to be of importance in the future, but there are no guarantees. So keep an eye for that as a potential support area just north of 158 for sterling yen. If you bear with me 1 second now, please, I'm just going to run it through some of the questions that have come in. So, quick question: will the projected release of oils by US dent huge, but the USA dent huge price rallies? I don't necessarily think we've already seen oil drop by about 4 or 5% today. So I don't think we're necessarily that story, now that it's out there, is necessarily going to be continued to hang over the oil market. What the message it does send out, though, is that if there is an energy crisis, or there's a persistent energy crisis, or fears about a persistent squeezed supply of oil, the fact that the US are willing to release oil from their reserve, it's a very important signal, because it could suggest they will do it again and again. It's not something they like doing, but the very fact that they're considering it says a lot. And if they go ahead and do it, and then oil continues to be at an elevated price, they might look to do it again. But to be honest with you, it's difficult to second guess what the US are going to do or what they're not going to do. But ultimately, I don't think it's going. I think it'll be a big story for 24 hours, for 48 hours. But I don't think it's going to be hanging over the oil markets, because very quickly, news items become old news in the markets. Next question now. Comment on the JPY: is a hedge risk, and why has it been receding? It's been receding because of the value of stock markets. I mentioned a minute ago, it's no coincidence that we saw weakness in the Japanese yen against the British pound and the US dollar. At the same time, we saw a 1-month high in the FTSE 100, and at the same time, we saw a 3-month high in the S&P 500. So if anybody trades JPY, any yen crosses, you have to look at what's going on with stock markets. If stock markets are rallying, it's fairly common to see that the Japanese yen falling, and if stock markets are falling, it's fairly common to see the Japanese yen rising. In relation to what moving averages are you using? So I'm using a 20-period moving average, a 50-period moving average, and a 100-period moving average. So these are a fairly common setup in terms of moving averages. And I think I got a question here about the US 30. I'm aware of the time that it kind of gone on for a bit longer than originally planned. So I'll take a look now at the US 30, and then if there are no more questions, I'll look to wrap things up there. Uh, 483. So the US 30, like similar situation to what I was saying about the S&P 500. Think about this. Since the middle of March, what have we had? We've had a hawkish Federal Reserve. We've had continued violence and uncertainty in Ukraine, but that didn't stop the stock market rally. We've had a very impressive rally. It's been driving higher, back up to levels last seen. I think it's in this week, we got back up the levels last seen in early February. So we're talking about a 6-7 week high has been racked up. So this is what I mean about ask yourself the question, what are the markets telling me? Some people out there might be, especially new to the markets, going, all the headlines are negative, the news is negative, higher interest rates, war in Ukraine, the market should go down, the market should do this. In my opinion, when you start saying the markets should do this, you generally lost, because the markets do what they do. And for someone like myself, who is a big believer in technical analysis, the study of charts, I would always be asking myself, what are the markets telling me? And you can see here, the market was breaking higher and higher, creating multi-day highs, multi-week highs all the time, that the news and the headlines were by and large negative. And the fact that it's not really a surprise to me that we've now gone on to kind of hit a 6-7 week high in spite of all that, because the market was telling you along here it's going higher. We recently hit its highest level since early to mid February, which underlines how bullish the recent uptrend is. If we continue to hold above these two simple moving averages, I know we've just dropped below the moving average, but we're still comfortably above the 50-period moving average and the 100-period moving average. If we continue to hold above these two metrics here, it's likely the broader upward trend is going to continue. A rally from here could see a target 35,439, and a break beyond that could see a target 35,870. Now, if we do look to kind of continue in the short-term bearish move, keep in mind the market retreated from most recent peak. Markets pull back from time to time, such as here, such as here, such as here, such as here. Pullbacks happen. If you look at the thematic indicator, momentum's in negative territory. The RSI is moving lower. This points to kind of suggest the bears are in control. If you do see further losses or further declines in the US 30 from here, where we're going to find support, well, I'm looking back down toward this area here, around 34,686, and a break below that could see us back down toward this zone, this simple moving average here, the 100-period moving average, and that comes into play in around 34,483. And if you follow this moving average around, you can see how it acted nicely as a resistance point up here, a resistance point up here, a resistance point up here, resistance and support kind of both at one go, and then it moved higher. And this is what I mean about when you're looking at potential areas of support or resistance, you always need to look, has this metric been of importance in the past or not? And if it has been of importance in the past on several occasions, it makes it more likely to be of importance in the future. But of course, there are no guarantees. Euro-dollar long-term holding position, a good idea for a sell? Is one of the questions. Well, going back to euro-dollar, the very kind of longer term outlook for euro-dollar is clearly bearish. Look at this downward trend here. I'm not looking on a daily chart. We can see that a nice series of lower lows and lower highs all the way along. The lows that we saw here in early February were levels last seen, I think it was about 22 months ago. It wasn't quite a 2-year low, but it wasn't too far away from it. Now, granted, we have in the last few days, and the last few weeks rather, we've seen a higher high, a higher low, a higher high, a higher low. But it's possible that this series of higher highs and higher lows might just be a kind of a counter trend or a rebound before ultimately the more overpowering longer term trend kicks in again. Even when we've rallied, the rallies that we're seeing here, only now the recent peaks are sort of breaking above the lows that we're seeing here. We haven't even retested some of these peaks along here. We haven't even gotten close to retesting the 100-day moving average. And if you follow it around, the 100-day moving average acted nicely, acted as resistance here in early February. It acted very nicely as resistance here in mid-January, and acted very nicely as resistance here in early September. So that metric for me is probably the big one to watch out for. While we continue to hold below the 100-period moving average, I think the kind of broader bearish trend in euro-dollar is going to continue. If we were to break above that, then I'd like to kind of change my view and think okay, maybe the overall uptrend is going to continue. Maybe this more medium-term uptrend, this medium-term rebound is going to continue. I do think I'm looking at the time here. This is going for a bit longer than other live webinars, which of course is very much welcomed. I've now managed to kind of cover, I think it's about to say close on about 10 markets in that time period. I do want to thank you for your time, because the last few of these live events that I've had, they've ran for about kind of 15-20 minutes. We're now going on for a 40-minute run, so I'm going to look to kind of wrap things up there. Please sign up. For those of you who are clients, I'm hosting a non-farm payrolls webinar tomorrow. It's covered on our website, on FX Page's website and Twitter account. It's covered on Equity Nigeria's account as well. For those of you who are on Twitter, feel free to sign up to follow me on Twitter. This here's my profile on Twitter at @dmadden_equity. Is my Twitter profile, my Twitter account. Feel free to follow me on that. Ask me questions on that as well. I can't actually give advice because it's not a part of our business, and my compliance department wouldn't be happy with that. But what I can do is kind of give you, like with today's update, I can give you thoughts and opinions and views. So I am going to look to wrap things up there. For those of you that are around tomorrow, just about 1 hour before the US market opens, when the US non-farm payrolls report comes out, I'll be doing a live webinar on this. My colleagues who you've been in contact with at the sales teams, either at Equity Nigeria or FX Payza, they'll be able to point you in the direction of the links. If you follow me on Twitter, or if you follow the various different brands on Twitter, FX Payza or Equity Nigeria, you should see those links as well. So I'm going to look to wrap things up there. Everyone, have a good evening, have a good night. Thank you very much, and hopefully speak to you next week or tomorrow. Thank you very much.